Hi, this is Bill Joyce, and I'm the broker at Charter Home in Sacramento and a blogger at survivingtheamericandream.org. While I'm an advocate for home ownership in general, I've seen the kind of pain and suffering a poor home choice can have on a family's finances, marriage, health, and overall happiness. I believe the oversold and underdefined image of dream home encourages people to spend far too much money for the wrong kinds of things. Buying a house doesn't get you the life you imagine, or the time to live it, any more than joining a gym will make you fit. It takes discipline and effort to create the things you dream of. You can't simply buy them. Join me while I interview experts in various fields like financial planning, marriage and family therapy, career counselors, life coaches, as well as happy and unhappy homeowners willing to share their hard-earned wisdom. Knowing how to make wise home choices will make your life better, happier, and more financially rewarding. Learn how to find the right home for you and how to make it the home you dream of for the life you want to live. Today I'm interviewing Denise Downey, a certified financial planner from Spokane, Washington. Denise has an interesting background in financial services from Chicago and now has her own fee-only financial planning practice. She provides investment advice, retirement and college savings planning, as well as financial education and advocacy. She also shares her personal story about home purchases and offers suggestions that will help people plan for themselves. Why don't we start off with just a little bit of background on you, some of your history and what brings you to where you're at today.
Sure, yeah. So I actually spent most of my career in Chicago, actually all of it up until just this year. And I started about 16 years ago. I've always been in the financial services industry, just different areas of it. So I actually started out as a stockbroker back when the days when those existed at TD Waterhouse. That was in 2000. So if you recall, that was right when the tech bubble was bursting. That only lasted about a year before the whole Chicago office was shut down, just because of the recession. Then I actually worked at the Chicago Stock Exchange for a little bit. And then from there, I went over on the bank side, I went to, at the time it was Bank One, but then they merged with Chase. But I was on their investment side. So I worked there for about 5 years, all on the back office side. So I handled their trade desk. I managed their fixed income desk, their equity trade desk, their client service center. So lots of back office experience there. And then, in 2007, I realized I wanted to, go down the financial planning route. So I transitioned over to Fidelity Investments, got my CFP and started working with clients. So I've been sitting down face to face with clients, helping them with their personal finances since 2007.
Okay.
But I've been in the industry about 16 years. And then most recently, I left Fidelity last year, made the move from Chicago over to Spokane, Washington. My husband's from here, and we have two small kids, so it seemed like a better place to raise kids. And always wanted to open up my own firm, so went off on my own. And earlier this year, I launched my firm. So I'm a fee-only independent advisor.
Well, now the fee-only independent advisor is a big, I would think, commitment business-wise.
Yeah.
And with your background in trading and managing investments for some big companies, what made you choose to do it that way?
Well, I wanted to do fee only, and the reason why is I like financial planning and I don't like sales. And if you're not fee only, that means that you are compensated by the products that you sell rather than the services that you offer. And I found that, I just wanted to help clients and I didn't want to have to worry about how helping my clients was going to affect my paycheck. So I didn't really want to have to worry about, did I sell enough annuities this month, or how many people can I get in managed money before the end of the quarter so I can hit my goal? I just want to help people. I'm taking a little bit of a pay cut for doing that, but it just makes me feel better about what I'm doing. And I think it makes me go into a little bit more detail with my clients. An example would be, with home buying. If I were to help somebody at Fidelity put together a budget to buy a home, and nothing against Fidelity, and many firms are set up this way, I wouldn't get paid for that. I only get paid for selling products. And so, I mean, I get a salary there, but that's not where my bonuses are. So anyway, I just really wanted to be able to help people from all aspects of their finances. So that's why I made the decision to go fee only. And then working on my own and going off my own, it's just a dream that I've had to always be self-employed. I have two small kids. I want to be there in their lives. Prior to making this decision, a nanny was raising my kids, and the financial services industry, in my experience, has not been very flexible with the work-life balance. So this allows me to, be there for my kids. I can take my kids to school. I can, be there on their first day of school. If they're sick, I can stay home with them and just kind of fit in work when I can.
That sounds great. The comment about helping someone in their home purchase and taking the time to help them put together a budget. Yeah. You don't get paid in for most companies that are giving financial advice based on sales. There's no money in that, and those are the people that know how to put together budgets are really the people that should be helping a home buyer figure out how do we save for a down payment. Right. And the money, almost all of the money out of this enormous sector, financially, the real estate and home mortgages, all of the money is around transactions, buying and selling houses. So people don't say slow down or don't buy or don't move. Stay in your house. The advice that discourages transactions, the advice that says be cautious and careful, there's no money behind it, so very few people are able to spend the time promoting that.
Yeah, that's interesting. I never thought about it that way, but you're absolutely right.
And now you could get paid as a fee advisor to give the best advice. And you could tell somebody, wait, why would you move? You want a bigger backyard? That's a nice thing, but look at how much it will cost you to sell that house in the commissions and transaction fees, and then buy another one and move and all of the things. And if you were to take that amount of money, you could fund 2 college funds with that. And, there's an alternative way to use that kind of money. And mortgage brokers aren't giving that advice. Real estate brokers aren't giving that advice. All the money is about, hey, get your dream home. Let's get another one. Let's move. Let's buy income property. So that's part of the direction I want, is this unbiased. Where does it make sense? What stages in someone's life is it a sensible thing to do? And purely like the path you're on, the fee only, it's purely for the benefit of that individual. And I think that's an important distinction. How long should people intend to stay in a home when they're going to purchase for that to be a sensible choice financially?
I would say at least 5 to 10 years. You never know. You could get lucky and the market could swing in your favor, but I don't know, buying real estate for short-term fluctuations, in my opinion, is not a good idea. So I would say 5 to 10 years. That way, if the market does go through a downturn and real estate prices do drop, typically in 5 to 10 years, they'll be back. But you don't want to get yourself in a position where you have to sell before then.
So going to a bank and asking them how much you can afford is really how much are you eligible to borrow? And that's not how this should be done. People should choose how much they spend. How would you guide someone in that process to figuring out how much they should spend?
Sure. Yeah. And one of the things that, the banks have a kind of rule of thumb, and I usually go by that rule of thumb as the most extreme situation. And those rules are, they look at the debt to equity. And let me just take a step back. So typically when I have a client that says, hey, I'm looking to buy a home, or even any sort of big purchase that's coming down the road, step one is always just to get organized and get a feel on what their debt situation is and what their equity situation is. So, and sometimes that is a very educational experience for clients, and it could take a while, but I have them list all of their equity. So 401ks, IRAs, savings accounts, CDs, whatever it may be, and then also list all of their debt, which is, it could be student loans, car payments, mortgages, any credit card debt, anything like that. Then I calculate the debt to equity ratio, which is simply all of the monthly debt payments divided by the gross monthly income. And so that number, as a rule of thumb, should be below 36%. The closer you get to zero, the better on that. So, and what that is essentially saying is that you want to make sure that, no more than 36% of your monthly gross income is going towards the fixed debt expenses. You still have to pay for food and utilities and spending money. So you want to make sure that no more than 36% is going towards a fixed debt payment.
And that includes a mortgage on a home?
It would. And then if you want to get down into more detail, I would recommend no more than 28% of your gross monthly income should go towards a mortgage. So if you want to do some quick math just to see how much of a monthly mortgage payment you can afford, just take your monthly gross income, take 28% of that, and I wouldn't go any higher than that.
And banks, what do you know what they're lending at typically right now?
I don't, honestly.
Okay. I think it's higher than that. So 28% is your recommendation.
Yeah,
don't go beyond that.
That's kind of a rule of thumb, but I use that as a very on the high end. I really kind of want to see that under. I'm conservative, but I would say no more than 20%. The reality is things happen. You don't want. I've seen situations where, people move into a house. Actually, one of my friends right now is going through this. She just bought a house in June. She did all of her, math and figured out that she can buy this house and have $200 worth of spending money, each month. But she didn't realize that her daughter would be going to preschool in the fall, and that costs $400 a month. So now all of a sudden she's $200 a month short. So anyway, leave some wiggle room. So the 28% I think is, on the high end. I would go lower. I would say, somewhere between the 20, around 20% would be most ideal.
Okay. See, that's really useful. I think the rules of thumb that are out there, like the 28%, I think it goes higher than that is what the lenders will do.
Yeah.
Are not based on, they're based on, I believe, what they think are failure rates. When is it this loan would fail? And we don't want to go that high. Yeah. But we think people could, they won't foreclose. They won't walk away if it's at 33. They'll struggle along. And financially, they'll leave it to the borrower to decide, are they okay being house poor? As opposed to, and I think what people interpret it as, is this is what I can afford. And without much discussion about all the other things that make up a life, like having a child in school and there being expenses and wanting to put them into perhaps a private school or to get school clothes and all the things that come with having new friends and that's real life. Okay.
Yeah, and actually, to answer your other question, that 36% number with the debt to equity ratio, I've heard that lenders are going up to 43% on that, which I think is it's too high. It's I don't know what it was back in 2005, 2006, and 2007, but I really think that 36 should be at the very high end of your spectrum.
Down payments. These days, you can do an FHA loan with 3.5% down. What are your thoughts on a down payment on a home purchase?
Yeah, again, I'm really conservative with this. I would definitely say 20% because then you're going to avoid the PMI if you get the 20%. But so I wouldn't go any lower than 20%. But then I would also go back to the debt to equity ratio and put down whatever, then kind of back into your mortgage payment from there. But it's kind of a, balancing the down payment and the debt to equity ratio with your mortgage payment is kind of a science because you're balancing where your asset should go. But I would say no less than 20%, but 20% to 50% is the ideal number. It also depends on your situation. I have a client right now who is in retirement. She just retired and she's moving. She's downsizing, but space-wise, she's downsizing, but she's going from a small like rural area to a big city. So she's buying a small condo in a big city, but the price is, probably about the same. So in her case, we kind of did the math, and I really don't like advising retirees to get mortgages. So she can afford to pay 100% to buy the condo in cash. And in her case, I'm recommending it. It's going to leave her a little bit more cash strapped than if she were to get a mortgage, but she still has plenty of cash to fall back on. So kind of a long-winded way of saying it really depends on the situation. No less than 20% for sure.
Now, young families with very little money, and that's not a new quality about young families. Families starting out have very little money. In these days, the loans available don't require that much down, like the FHA loan with 3.5%, and it allows people without a lot of cash to get into a house more quickly, whereas perhaps in generations past, you had to save your 20% or gifts from family or some combination. What would you advise for a young family without a lot of cash starting out?
I don't know. The dream of buying a home is real, and it's a good investment in the long term, but you have to be ready for it. I really think that people should wait till they have the 20% down. We saw it firsthand a few years ago that if you put 3.5% down and the market goes down 5%, you're already upside down. You should not put yourself in a situation where that could happen. I also I don't advise this, but I think as a level of comfort, it's good to have equity in your home from day one in case something happens. If a medical emergency comes up, if you lose your job, something happens, first of all, I always recommend having an emergency fund on the side. That's rule number one of investing is always make sure that you have that emergency fund. But it's good to be able to rely on that home equity line if you need it. Putting 3.5% down is not going to give you much equity in the house at all.
No, I think it's a way to get in, and and you're right about the dream. The idea of owning your home and is very powerful. And it's there. It's this hand and a way to get into something now, and it's seductive. It's hard to say no. I don't want it right now. I'm going to do the disciplined thing. Your advice is hold off.
Yeah, I would say hold off. Make sure that you have a solid foundation before you go down that path of home ownership. It doesn't come easy, and I just bought a house last year, and already we've spent more on home repairs than I anticipated. So, you just have to be in a very secure financial place to go down the road of home ownership. And there's nothing wrong with renting. People should not be ashamed of it. People should not feel discouraged by it. There is a place in our financial budget for the renters.
Good. Which then leads to how then do people prepare for that purchase? Let's start with the example of the young couple or young family who are now needs to save 20%. And a home can cost, I'm in California, and a modest home is going to be $200,000 or $300,000, and they easily get to $400,000 and $500,000. So we're talking about a substantial down payment at 20%, where $50,000 perhaps, even on the most modest of homes. Any suggestions for budgeting and saving?
Yeah, so usually I start with, depending on the client and depending on, what type of client they are, I usually start with, okay, how much do you want to spend on a house? How quickly do you want to buy a house? And, how much do you want to spend? That gives us a number. And then how quickly you want to buy a house? That gives us a number per month that they need to save. So from there, let's just say, they need, in order to meet their goal of buying a house in 2 years, for whatever the down payment is, they need to save $500 a month or whatever it may be. Then I go back to their budget and say, okay, where can we get this $500? And sometimes it is moving into still renting, but moving into maybe a smaller apartment or a little bit further away from the office, or, you just got to get creative with ideas on how to create that savings each month. I've had lots of clients decide to call it quits with cable. That's very common these days, is, that can save you $100, sometimes more dollars a month if you just cut that cable cord. Maybe it's going out to eat less. Maybe it's canceling some club memberships or magazine subscriptions or whatever it may be. There, in every budget, there is some room for, to create some automatic savings.
And you work with clients on the budget. You'll get a husband and wife together and you sit down and get into the nitty gritty of where the money's going?
I do. Yeah. It could be painful, but it's, I think it's a good experience. Yeah.
I imagine that could be painful. Do you find that couples need help? Objective, the third party voice on money issues, or do you find that many couples work, really well or poorly? What's been your experience in terms of how couples work with money?
I think the third party voice is good. And I think, even before I get to the picture, usually when clients come to me, they hired me. So they want a financial planner. So they've already come to the table ready to talk about finances. So it's not really like I'm pulling teeth at this point. But a lot of times I am just validating what they already thought. So for example, if one spouse is very, I don't know, let's say they have a hobby that they spend a lot of money on. They probably know that they spend a lot of money on it, and they're probably expecting me to say, okay, can we cut part of this out? So, a lot of times they're not shocked by what I'm saying, but it's just validating what they probably already thought.
That's interesting.
Does that make sense?
Yeah, no, it does make sense. Yeah. I think, but those are delicate discussions.
They are, and and I think just going through this process and even looking at the budget, I can't tell you how many people don't have a budget, and that's fine. I mean, if they're comfortable and they're not in debt and they're not looking to make any major changes, and it's okay to not have a budget. But when you get to the point of planning for retirement and trying to save more money or trying to save for certain goals, a budget is very handy. Even if you have a lot of disposable income, it's good to know where your money's going. So I just recently met with a couple that the husband liked to golf a lot, and so there was a lot once he sat down and looked at their credit card, there was a lot of money going towards golf. And he knew. So when we had the conversation, we talked about it, and I didn't even have to say anything. He just said, okay, I see that this number is higher than I thought. I know I need to cut this down. On the flip side, I just had a client recently that when she did the budget, she was shocked at how much she was spending on groceries each month. And I know I've been there. The cost of groceries is just been skyrocketing. But after getting over that sticker shock of seeing how much was actually going out the door at groceries, she looked at what she was buying. She was buying good food, organic food, healthy food. So she was okay with that. And she decided that wasn't an area that she wanted to cut back on. I think creating this budget also creates a lot of awareness about where your money is going. And then it helps you prioritize, what you're willing to cut back on and what you're not.
Well, I think that's a good thought there. I would think a budget would be a good idea for really everyone. Mm-hmm. And if you're really wealthy and you just don't need to worry about money, that would be one thing.
Right.
But I think most people, and it's it's an issue. They're not going to have enough to retire. Mm-hmm. The statistics of people who are going to be living poor as poor elderly people is kind of staggering. Mm-hmm. and just struggling to buy a home. No matter where you are in your life, most people have some financial goal or should, mm-hmm. and the budget's I would think the starting point. Do you know of any tools that would help? How do you start documenting someone's budget?
Well, credit cards make it very easy right now. The use of credit cards, even me saying that, is just making me cringe a little bit, but as long as you're paying it off every month, I think credit cards can be a valuable resource. One, for the points or whatever that you get on it, but then two, just for tracking mechanisms. And also, outside of credit cards, there's a lot of software out there right now that can track what you're spending where. Mint.com does it for you. There's plenty of options out there to track. As far as budgeting, I always recommend my clients use an app. It's really easy to use. It's called You Need a Budget, or YNAB. Very user friendly, and it just, you could use it right on your smartphone every time you make a purchase. So, we're living in a world where there's technology for everything. So I think we need to embrace that and just, find which one we're comfortable with.
That's excellent. Actually, I would think because it's all electronic, the need for cash goes way down, and you can make that go even further. You can just sort of make the commitment not to be withdrawing cash, and then you'll have a record of where you spend everything with very little effort. So I think that's excellent. Thank you. You Need a Budget. Is that that's an app? That's a phone app?
Yeah, there's a website to it too. Yeah, YNAB. You Need a Budget.
Okay, good. I'm going to include that in the article. Now, tell me a little bit just about your own personal experience with home ownership. Is this the home you just recently purchased? Is that your first, or did you own in Illinois?
I owned in Illinois too. We lived in Chicago and had a condo in Chicago, and sold the condo and relocated out here. So we had kind of, I guess, an interesting experience where we moved from very high real estate prices to pretty reasonable real estate prices. But yeah, I'm a financial planner and I'm very conservative, and so my personal experience might be kind of unique, but I could still walk you through it if you want. I knew that I would be leaving the workforce, when we left Chicago. So we wanted to purchase, and I knew eventually I would be going back into the workforce, but I wanted to stay home for at least a year with my children, because at that time they were 1 and 3. I wanted to spend some time with them. So we were going to be going from dual income to single income. And then also I knew that I wanted to start up my own firm, and I knew that would take some capital, and I wasn't quite sure how long it would take before I started to actually produce an income. So with all those things on the table, we were very conservative with our home purchase here in Spokane. So, we did, we looked at what we could afford, and then we bought half of that. So I wouldn't say half, but we bought significantly lower than that. We also wanted to make sure that the mortgage payments that we were going to have, we would be able to pay on one income. So we wanted, when I entered the workforce again, we wanted that just to be, gravy, or just, we could save for vacations or college savings or whatever it may be. So that's kind of the process we went through. And we had a budget, and it was a conservative budget, and we ended up, coming in just below the budget, I think.
Okay. It's a choice, and what you can afford isn't what you can borrow. We comment on that. Lenders tell you what they'll lend, but what you can afford has to do with what do you want, and not just with a house. What do you want out of your life?
Right.
And if you want to not work for a period of time and be able to survive on one income, and that gives you a life that you're looking for, there's your budget. And the problem that people struggle with is that house isn't as good. It's just not as nice. And if they, did you ever even consider higher numbers, or even look at the homes that you could have purchased with more money?
So that's actually the problem with, and I know, you're a realtor, aren't you?
Yeah. You're not going to hurt my feelings. So I'm looking for really candid information. I'm not looking to sell real estate.
In my experience, I've had 2 really bad experiences with realtors. One really good one, actually 2 really good ones, because we used the guy that we bought our condo from in Chicago was amazing, and we actually used him to sell our condo too, and he was amazing again. But I've had experiences with realtors where you tell them that you want to spend $300,000 on a home, and they are showing you homes worth $400,000, $450,000. And I think it's just, it makes me mad, because I'm sure so many people see that house and it looks good because they know, it's outside their budget. They weren't planning on looking at a house like that. So anyway, I think that realtors tend to show houses that are higher or like higher than the budget or right at the upper echelon of the budget. And so yes, I did see houses that were on the high end of my budget or outside of my budget. And they were nice. And it would, I did have that, it would be really nice to live here. This neighborhood is really nice. Oh, the park is right there. That would be great. But you just have to bring yourself back and say, okay, no, because then if I move there, I will be stressed out every month as I'm paying the bills, and I won't be able to go on as many vacations, or I won't be able to, buy what I want at the store. So you have to think about how it's going to affect your life month to month versus, your overall happiness. A good example actually was, I moved to Spokane, Washington, and it's beautiful here, especially coming from Chicago in the Midwest where there's just no landscape at all. Here, there's lots of hills and there's, homes with views, and, it's stunning when you're not from around here and you walk into this house and there's just this huge picture window overlooking this scenic overlook, and you think like, wow, this could be my house. That's amazing. But then you have to remember, well, I had a view of this Chicago skyline from my condo, and that was pretty cool for a while, but you get used to it. And, so you don't want to pay for things that you're going to get used to like that.
That's interesting. There's such an important lesson there that if people can internalize and find that balance. I comment that I believe that people treat it like a consumer purchase in a sense. You get a budget and you get that from a bank, and then you're going to go comparison shop and get the best one, you can find.
Yeah.
And for most people, homes are so expensive, at least around here, and I think that's true, relative to incomes all over the country. It's easy to be disappointed with what you would be happy buying. Happy meaning with other aspects of your life. And that, a lot of people, it's surprising how many young families want that dream home. And the expectation, that bar is just so high.
Yeah.
Are there any closing thoughts or general ideas that you would want to promote or share?
The one thing I would say is, I didn't know where this could fit in conversation, but just a little, I guess, a tip or something to think about for home buyers out there is, when you go to the bank and you get a loan, they will usually ask for your bank statements. They'll ask for your pay stubs, and they'll ask about any debt you have. But they really only look at your current situation. And I'll use myself as an example. So when we got the loan for the house that we're in right now, I was working, and I knew that I wasn't going to be working once we moved here. And I told the bank that, and they didn't seem to care. So I would say that, the banks seem to only care about what your financial situation is right then and there. So I would encourage people to look forward and say, okay, what might my situation look like in 2 years? What might it look like in 5 years? What might it look like in 10 years? And buy a house, and take that into consideration when you buy a house. So that's why when my husband and I bought this house, we really didn't even want to include my income on the documents because we knew that it was going away. And I think that a lot of people might get into trouble when they, like that young family I mentioned before that, they knew that the wife was going to stop working when she had kids, but they still bought a house based on the dual income.
Well, that's a big thought right there. Banks are in the business of lending money. So it's not a gift. That's how they make money. So they're looking at how can I get them as much money as they want. And that's good for my business, and they seem to want that. And what I'm hearing you say is you shouldn't really be using that as the benchmark for making that decision. You should decide yourself how much money you want to spend, you would choose to spend for what matters in your life, which will include the home in addition to how you want to spend your time, your vacations, your kids, and so on. And so it sounds like that bank didn't care. because knowing your history is going to help get you as much money as you want to borrow.
Yeah,
Even though
right.
you don't have to spread the word to the bank that you're going to stop working.
Yeah.
But that is in your best interest. That's
Hmm.
that does let people get into trouble, unfortunately.
Hmm.
They
Hmm.
think getting as much money as they can is the path to happiness, and
Right.
it's
Yeah.
borrowed money, and that is not the path to happiness.
Yeah. You have to look out for yourself. I mean, we should,
That's
know that
right.
after what happened in, 2005, 2006, 2007. I mean, if everybody looked out for themselves, they'd be okay.
Right. Good. Well, Denise, thank you. I appreciate you taking the time today. Thanks so much.
You're welcome. Thanks so much.
Thanks for joining us on the Surviving the American Dream podcast. If you found this helpful, please leave a comment and share with your friends or family, and especially anyone looking to make their home happier.